Most traders fail because they try to predict reversals and strong trends instead of betting on continuation. The market is a constant search for fair value, driven by institutional algorithms. Many retail traders lose money not because they can't read a signal bar, but because they misread the environment. We are going to dismantle the 6 most expensive mistakes in price action trading. Mistake number 1 is ignoring market context. A perfect-looking bullish reversal bar is meaningless if it forms directly into a tight trading range's resistance. You must look to the left of the chart before you look at the current bar. In a trading range, the market seeks to fade breakouts. Buying high or selling low works in trends, but it destroys accounts in trading ranges. The probability of a successful breakout in a mature range is often less than 40%. Instead of buying strong bull bars at the top of a range, you should be looking to sell. Institutions sell these highs because they know the math favors a pullback. The correct trade is often the opposite of what your emotions suggest. Mistake number 2 is fighting a strong trend. When the market creates a series of strong trend bars with little overlap, this is a breakout phase. Traders constantly try to pick the top, thinking the price has gone too far. In a strong breakout, there is no resistance. Previous resistance levels will be sliced through. Betting on a reversal here is a low probability wager. You are stepping in front of institutional volume that is desperate to buy. The solution is to wait for a second entry reversal. A trend rarely dies on the first attempt. It usually tests the extreme again. If you must counter trade, wait for a double top or a double bottom to form first. Mistake number 3 is chasing the market, also known as buying at the top of a climax. When a trend accelerates and produces the largest bars late in the move, this is often an exhaustion gap, not strength. If you buy a huge green bar far above the moving average, your risk is wide and your profit potential is limited. Smart money takes profits during these spikes. You are providing the liquidity for them to exit their positions. Instead of chasing, you must develop the patience to wait for a pullback to the moving average. This improves your risk-reward ratio significantly. In a strong trend, the 20-period exponential moving average acts as dynamic support. Mistake number 4 is improper stop placement. Many traders use a fixed dollar amount stop, like $50 or 10 ticks, regardless of volatility. The market does not care about your account balance. It cares about price structure. Your stop must be placed beyond a technical barrier where the premise of your trade would be invalidated. If you are long, your stop goes below the most recent higher low or the signal bar. If the market hits that price, your setup has failed. If the correct technical stop requires more risk than your account allows, you must reduce your position size, not tighten the stop. Tight stops in a volatile market guarantee you will be stopped out of winning trades. Mistake number 5 is moving stops to break even too early. Traders do this to remove emotional stress, but it makes no mathematical sense. You are exiting a trade at a price that likely has no technical significance. The market often retests the entry point or breakout point before resuming the trend. If you move your stop to break even immediately, you will often be taken out on a test, only to watch the market hit your profit target without you. Mistake number 6 involves the trader's equation. Many traders take low probability trades without sufficient reward potential. You must balance the probability of success with the size of the reward relative to the risk. In a trading range, probability is often near 50%. Therefore, your reward must be at least twice your risk to be profitable. In a strong trend, probability is higher, so you can accept a reward equal to your risk. Another trap is ignoring barbed wire patterns. This occurs when 3 or more bars overlap significantly with prominent tails. This indicates indecision and algorithmic fighting. Do not trade inside barbed wire. Barbed wire usually acts as a magnet. If you buy a breakout from it, the price often snaps back. Wait for a clear breakout and a subsequent pullback away from the wire before entering. Let's discuss the error of limit order trading for beginners. Professionals often use limit orders to fade breakouts, buying below bars. Beginners should stick to stop orders, entering only when price moves in their desired direction. When you use a stop order to buy above a prior bar's high, the market is proving you right instantly. The momentum is with you. Limit orders require you to endure drawdown and possess a deep understanding of support levels. A subtle mistake is failing to recognize measured moves. Markets often move in equal legs. If you don't take profit at a measured move target, you risk holding through a deep correction or full reversal. Measured moves are self-fulfilling prophecies because algorithms are programmed to take profits there. Identifying the first leg of a trend allows you to project the target for the second leg with high accuracy. Overtrading stems from the desire to be in the market constantly. The best trades are obvious. If you have to stare at a chart for minutes to justify a setup, it is not a good setup. You should view your capital as inventory. You don't want to sell your inventory for a loss just to feel active. Wait for the setup where the institutional pressure is clearly visible in the candle bodies. Another error is confirmation bias, only seeing what supports your position. You must constantly ask, what is the counter-argument? If you are long, where would a bear sell? If the bear case is strong, exit. For example, if you are long in a bull trend but see 3 consecutive bear bars closing on their lows, the probability has shifted. The bear case is now strong. Hope is not a strategy, reading the bars is. Ignoring gaps is dangerous. In price action, a gap isn't just open space. It's any area where price has not overlapped. Gaps often act as magnets and then support levels once filled. Finally, the mistake of forcing the daily goal. The market gives what it gives. Some days are narrow trading ranges with no good setups. Forcing trades on these days is how you give back a week's worth of profits. To fix these mistakes, start by reducing your trade frequency. Focus on the best 10% of setups. A high 2 buy setup in a bull trend or a low 2 sell in a bear trend are your bread and butter. Record every mistake. Was it a context error? A stop placement error? Emotional execution? Categorizing your errors is the only way to eliminate them. You cannot fix what you do not measure. Trading is not about being right every time. It is about executing a proven edge with discipline. Eliminate these 6 traps, respect the market context, and the math will take care of the rest. Trade what you see, not what you want to see.